Hi, I'm Greg Corombos. Welcome to Banking Compliance Insights by Wolters Kluwer, a podcast series from Wolters Kluwer. This series was created to deliver insights on compliance trends and strategies for navigating today's regulatory and risk environments. Today's episode, Electronic Lending and Participation in the Secondary Market, focuses on modernization of loan transactions and the diligence required to be successful. Here to lead our discussion on this subject is Wolters Kluwer Vice President of Banking Compliance Solutions, Samir Agarwal, and he is joined by Spencer Mierzejewski, Senior Legal Counsel at Wolters Kluwer. Samir, let me pass the conversation over to you.
Thanks, Greg. The dynamics of lending have always been quite interesting to me. The business is typically made up of banks make a loan to a borrower and they collect interest income. Seems pretty simple, right? But what if you don't have enough reserves to organically do just that? You require loan participants on the rear end, or maybe even sale of the collateral on the secondary market to complete the transaction ultimately. Everything's electronic now. And we've invited Spencer to join us in a conversation to discuss how important digital capabilities are in the origination process and the effects that it has on the downstream need to participate in the secondary market. Spencer, welcome. Tell us a little bit about yourself and what do you do for Wolters Kluwer?
Hi, Samir. Thanks for having me on, and I'm really excited to be here to talk to you about this. So about me, I'm an attorney. I've been an attorney for about 10 years, and I've had a range of experiences going all the way from large publicly traded companies to a two-employee startup. For the past 5 years or so, I've worked for eOriginal, and then in December, when the WK team acquired eOriginal, I joined and came on board to work at Wolters Kluwer. My primary role is working with our customers who are trying to transform their digital lending business as seamlessly and as compliantly as possible. So what that means for me, and one of the most fun things I get to do, is work broadly across our customers' organizations to make sure that everyone understands what the requirements are and that they're implemented as correctly as possible.
You know, originations is always about speed and hey, getting the loan complete, but then the rear end is the collateralized part. Tell me a little bit about where, the current state of digital lending is.
So currently, what I'm hearing in the digital lending space is a lot of questions about, one, going end to end for the digital lending transaction to do it entirely electronically. And then the other concerns I'm hearing are about speed and reliability. There's always this tension in the banking world of matching up how quickly you can get things done against how compliantly and accurately you can get things done. I think a lot of banks see digital lending as a way to get the best of both worlds. They get the added speed of electronic processing combined with the added reliability of a system that takes the guesswork out.
So let's talk about that a little bit. I know that the front end of it is more of like a vanity. I say it just lightly because we talk about in today's world, you can do everything from your phone. And folks want to do things that fast or have instant gratification around that. And it clearly comes with some criteria that's required in order to do so. Can we talk just a little bit about that? So how does digital lending play a role in just the front end of that?
I think what banks are hearing from their customers is that they want to do things completely electronically. They don't want to have to come into an office. They want to start on their phone, move to their computer, and then maybe even finish on their tablet. And banks want to be able to cater to their customers and meet them where their customers are.
That makes total sense. And I'm probably going out on a limb, but it curbs a lot of human error. So what does that mean when we talk about reliability and being compliant?
Yeah, so in terms of mitigating the human error and increasing your compliance and reliability, the electronic process really levels everything out and makes it very easy to follow along. So you may have a loan officer that's under a lot of pressure to close out a loan, and some information may be missing, and they might find it easier to just simply file an internal exception to sort of push it through the process. But when you have an electronic system set up, all the fields will be clearly defined. They will be required to be filled in to move to the next one. And you can even set it up with help boxes to say, this is why this is important, and this is how the information should be formatted, so that you know that by the time it works its way through the process, that loan is accurate, complete, and filled out the same way each time.
That's a win-win. That sounds awesome. So in today's world, we're in a pandemic, and electronic transactions have really accelerated almost in every facet of our lives. Can you talk a little bit about what's been adopted and what hasn't been adopted in digital lending?
Really, you can start to finish do everything that you would normally in a paper-based world in an electronic or digital process, from the initial loan application to, of course, all the credit checks and all that, but then to filling out the paperwork, to having the loan funded. And then even if you're the originator, you can take that loan that has been electronically created and you can move it onto the secondary market all electronically without ever using a piece of paper.
That's quite impressive. I'm curious, how much time is actually cut out of the process on average when you remove paper from the equation?
Well, I think it depends a lot on a case-by-case basis, and sometimes customers are really willing to share this information with me. Sometimes they're not. But I do know that Wolters Kluwer has worked with one of their banking customers who estimated after they had fully implemented their system that they were saving about a week on each transaction in terms of processing, fixing forms that were filled out incorrectly, or even things that you don't normally initially think about, like if you needed to reference a loan, searching for an electronically created loan in an electronic system is much quicker than having to go to a paper file, look through all the files by hand, and then pull out the correct one.
Those are real hard costs. I mean, when we look at it from an operations perspective. So how does this also increase compliance?
In terms of compliance, we've talked a little bit about kind of removing the human element from it, but there's also some real benefits to automatically and compliantly getting out all of the required documentation and assembling that into the completed loan package. So a good example is in the auto space. There's a lot of disclosures that have to be filed in conjunction with all new loans, and they tend to be government required disclosures. And when you have an electronic process, you can be sure that each time a loan goes through the system, those disclosures are automatically sent to the customer, and then the customer has to acknowledge them electronically to move to the next step. And then on the back end, if your compliance officer wants to prove to a regulator that this was followed, it's very easy to go in to search those files and to, one, have the confidence to say to that regulator, I know I've done this 100% of the time because my system won't let me do it any other way. And also to then pull that up and get that evidence in front of your regulator.
When you were giving us a little bit about your background, you said you had experience working with all the different departments at a financial institution. And what I'm curious about is each one of those departments has a stakeholder kind of presence on a transaction, whether they're a parent in the immediate or really working in the back office. They all have a stake in that transaction being successful and compliant. Can you just talk a little bit about the electronic process and what does it do for each of the departments? Does it give them comfort? Are they notified when errors happen? Or how do each one of those department stakeholders think about digital lending? Is it positive or are they skeptic?
Well, I think you get a mixed result based on what role somebody's in. For example, I am a lawyer and I speak to a lot of lawyers that represent our customers, and they tend to be very skeptical when they first sit down and they say, I don't know, I've always done this on paper and I don't know if I want to move away from that. I know it works and I like to keep it. But then when we can start talking about some of the problems they experience, like, well, what happens when you do have an audit? What happens when a regulator asks to see your records? Or even as simple as, what happens when you have to move all of your completed loans from one custodian to another? Then that's when people start to see the value, and then they tend to jump on board very quickly. So a good example would be even just customers who are moving their completed loan portfolios to a custodian. Some of them are paying upwards of $800 just to ship boxes. They have to put them on a FedEx truck. It takes a week to get to the custodian's office. In the electronic world, they have one of their operations team members sit down. They select the loans to move. They hit send. The custodian accepts them, and within a matter of minutes, they're transferred.
It's pretty amazing. I cut out a lot of time and a lot of diligence work all done at the same time. Does it make diligence over the portfolio easier?
Absolutely. And that's one of the biggest growth areas right now, I think, in digital lending is what we're seeing is a lot of companies are saying, I want to do this digitally because it helps my diligence process. So it could be as simple as just having all the information available to be searched. It could be that you can associate some of the technical details with each loan with that actual transaction. So if you're trying to say you want to pool your loans and tranche them by credit score, in the digital world, it's a lot easier to do that because you know what the credit score is on each of those without having to look at a cover sheet or individually review them. And even then, when you do sort of set up those packages and a third party wants to come in and do the verification, it's much easier for them to be able to log into an electronic room, look at the documents, do that verification, and they don't have to, say, travel to your warehouse or your custodian and look at the papers individually.
So I want to go back to talking about compliance teams and all the different stakeholders. What other ways can the adoption of a completely digital origination process make a compliance team feel really good?
Well, one customer I talked with told me that it made their regulated compliance much cheaper. Every time a government regulator comes in and asks to see the records, even as part of a routine audit, they're now able to present those records by logging in from a central location and viewing them electronically. They no longer have to, say, travel to each branch location to see what may be stored there. Another example that really helps our compliance officers sleep well at night is that they know that if a disclosure is required and it's part of the electronic workflow, it'll be there 100% of the time. And so that gives them confidence when they meet with their auditors and their regulators to know that their ducks are in a row and that they're going to pass with flying colors because they've followed the process each time.
Are there any increase in the level of security with electronic documents versus physical?
So this is actually one of my favorite things to talk about. And it's one thing that I think people are very surprised to learn. There's this prevailing notion that we trust in our paper and we trust in that wet ink signature on a document and that your signature is your word. But when we start to kind of really examine what that's based off of, there's a lot of ways that electronic signatures and electronic documents are a lot more secure. A great example is if there ever was a catastrophic loss. I worked one time on a case where an Iron Mountain storage facility had actually burned down and all of the paper contracts stored inside were just completely gone. They were either lost in the fire or they were lost when the firefighters came and put water on it to extinguish the fire. There was no way to recover those documents. They simply were gone. If they were stored electronically, there would have been a backup system. It probably would have been geographically diverse from the original system, and you can recreate those documents. And believe it or not, the law is really embracing this. And the UCC code, for example, supports recovering an authoritative electronic copy from a backup if there is a catastrophic loss of the original.
That's interesting that we can recreate the electronic pieces and they're compliant. How do you end up proving that they're authentic? Is that because the electronic version has an authoritative backup?
So again, this is another one of my favorite examples to talk about. When you talk about proving the authenticity of a signature, it essentially comes down to what testimony you can provide in court to reliably say that this is the person who left their signature on this paper. And so when you have a paper signature, you end up doing things like it's a eyewitness testimony to, oh, I'm the loan officer and I saw this person sit in front of me and I can identify them from my memory. Or you're like hiring a handwriting expert who is comparing two signatures and then giving testimony based off of that. In the electronic world, though, there's so much more. You might have an IP address. You might have timestamps. You would have the login information entered by that customer who signed it. You would know the email address it was sent to so they could receive that electronic signature if they did it remotely. There are webcam-based online notary services. And a lot of modern electronic signature systems have ways to capture either like biometric data or what we call knowledge-based authentication, which is things like sending a PIN to a cell phone or having a third-party service call a signatory and ask for something like their zip code or license number or something that would be stored in a publicly available database and confirming their identity that way. So if you ever were trying to prove that the person who you think is bound by this loan is the person who applied their signature, I think in the electronic world, you have a lot more ways to prove that than you do in the paper world.
So how do we shift the mindset that the electronic world is better? What actually gets people on board?
That's the $1 million question, right? And if I had the single answer to that, I would write a book about it, I would sell it, and I would retire to an island somewhere. But the way that I've solved that problem in my life is by trying to tie it down to a real world example. I think we talk about a lot of esoteric stuff, and it's these kind of like theories about what the law says. When you sort of apply it to a real world situation, that's how that executive or that compliance officer understands the risk and the value.
All right, so let's get into it. Let's get into an example. Are there any clients or maybe just any institutions that you can kind of give an example where you've gotten them on board and they started seeing the real world value that it brings?
Yeah, so one that we've talked about just a little bit briefly earlier was a customer First National Bank and they were the ones who told us that they saved about a week in time by converting to an electronic process. And then if we talk about kind of on the secondary market, the original had a customer who was originating student loans for for-profit universities. One of those colleges lost its accreditation and the loans were mostly forgiven. In order to try and shore up its books, that originator then issued more securities to try and use the new investments to pay their current liabilities. And so in short, what they essentially did is turn themselves into kind of a Ponzi scheme. The SEC came in and placed them into a receivership. And what happened is that their secured lender was able to take control over the electronically stored collateral in what essentially amounts to a repossession. By doing so, that pool of collateral never even became a part of the SEC receivership, and therefore that secured lender was able to retain 100% interest in that pool of loans that they had that perfected security interest over. And so they never even made it into the receivership. The secured lender found that they were able to then negotiate those loans, the ones that were still performing or still had value, back onto the secondary market. And while they obviously didn't recover their full exposure, they did a lot better than they would have if they just became another creditor trying to get money from the wind-up proceedings.
Wow. Yeah, those things take a long time usually. And you're saying that it was within 24 hours of a status change that they were able to take control?
Yeah, better than 24 hours because it was as simple as sending notice and then making those changes in the software.
So then how does managing the assets electronically translate into more of a benefit for the secured lender, right? You're saying that the lender in that situation was then able to decipher performing versus non-performing. They're not part of the receivership and actually then apply tactics around the performing portfolio.
Yeah, absolutely. And so, like we said, it was a matter of seconds that they were able to take full control. But even then, once they had control of those, that lender was able to then just have their regular loan operations team log in from their regular offices, view the original copies of all those documents, and make sure that they were accurate. They were able to quickly identify which ones still had value. And then to top it all off, because they were already managed electronically, it was relatively trivial for that lender to then put those back onto the secondary market. They never had to fly people to a location. They never had to worry about trying to get keys to turn over a lockbox. And then it was very easy to sort of pull into essentially Excel files what they had in that pool and then share them with potential investors on the secondary market.
That's really interesting. And it just opens the door to what else can I do if I were to have digital capabilities like that. So thank you for all the information, Spencer. Tell me, what else can Wolters Kluwer do that helps lenders that are considering entering this space?
I think there's a couple things. I think one of the biggest benefits of Wolters Kluwer is that there is such a broad base of experience and knowledge at the company as a whole. And so when we talk about converting to electronic and digital processes, it's very important to have it be one, end to end, but two, to have all the right people and all the right teams come together and sort of all work on this. So you want your legal team involved. You want your financial markets and capital markets team involved. You want your compliance team involved. And you also want your operations team involved, the people who are going to actually log into the software and manage it. And when you bring all that knowledge together, you need a trusted provider that has a broad base and wide experience in the industry who can take all that information in and then partner to build an electronic process that not only meets the standards of the paper process, but exceeds it in terms of speed, reliability, and compliance.
So thank you, Spencer, for joining today. Definitely enjoyed this conversation and can't wait to have another one.
Thanks, Samir. I've really enjoyed joining the Wolters Kluwer team. I look forward to many more years here working with all the great professionals, including yourself.
That's Wolters Kluwer Vice President of Banking Compliance Solutions, Samir Agarwal, joined on this episode by Spencer Mierzejewski, Senior Legal Counsel at Wolters Kluwer. Wolters Kluwer hosts this podcast and is a market-leading provider of advisory services and technology solutions for optimizing compliance and risk management programs. For more information and additional guidance, please visit wolterskluwer.com or call 1-800-397-2341. We also invite you to subscribe to the Business Compliance Insights podcast at Apple, Spotify, or wherever you get your podcasts. And please join us for future podcasts focused on navigating emerging trends in regulatory compliance.